Hi there, I'm Dara McDermott for another episode of Commodities Corner. I have Nick Trevethan, a commodities strategist in Singapore on the line. So Nick, the Reserve Bank of India has taken a series of measures since January to curb demand for the bullion. Now, can you tell me about this latest measure they introduced this week and what sort of impact will it have on demand and prices?
The RBI have actually been trying to curb gold imports since early 2012 when they changed the tax structure. And this latest measure, although not a tax, does seem to be yet another attempt by the RBI to try and do something about its current account deficit, part of which is caused by the country's appetite for gold. That said, what will it mean? We've already seen a very significant fall-off in Indian gold trading activity, import activity. But I believe what's happened is that gold, rather than moving in via official channels and being picked up in the statistics and in the trade data, is now moving in through unauthorized channels. India's always been adept at smuggling gold into the country, and I think this latest measure is just going to encourage even further levels of smuggling. There are estimates out there that they could be bringing in 150 tons of gold into the country through unauthorized channels this year. My feeling is it's probably going to be even higher than that.
And Nick, do you think we will see more measures like this by the RBI?
In terms of what it actually means for the official data, it will have the desired effect, or it seems to be having, and this and the other measures do seem to be having the desired effect. As I said, we have seen a slowdown in the official data. India has proved not shy at bringing in further and other measures to try and slow gold imports. I don't see what they can do further now other than maybe introduce strict quotas on levels of imports, but that's just going to drive even more of the gold trade into the smugglers' hands.
And what are we seeing in terms of demand from Asia, in particular from China?
Chinese demand earlier this year certainly was very strong. Chinese banks were buying up to a ton of gold per day, and you have to put in mind that the physical mine production of gold globally is maybe 2,800 tons. And with Chinese banks buying a lot of gold earlier this year, I think the recent price fall will be seen as a buying opportunity. At the same time, though, that volatility that we've seen in prices in the last couple of months has caused people to perhaps be a little bit reluctant to step into the market. That said, I think if we see a period of price stability, physical buyers are going to be coming back in a very big way. And I think the demand. I think the outlook for physical gold is very strong. What we have to get past is the selling in financial markets. For example, during the big sell-off in the last couple of months, we were seeing as much as 40 million ounces of gold traded on COMEX in a single day, and that's nearly half global production in a year. Once we've seen these financial positions, this sort of financial stake in the gold market move away, I think supply and demand fundamentals are more likely to reassert themselves, and prices at and above current levels, I think, look highly probable.
And finally, what is your price forecast for gold in the short, mid and long term?
In terms of price forecast, I wouldn't be surprised to see gold back up around the $1,400 per ounce level by the end of the year. I think in the longer term, we should also be looking at a higher gold price. Gold grades around the world have been falling for the last 30 years or so. There have been no major discoveries of high-quality gold reserves in that period. And there's also, we're seeing falling ore grades. These falling ore grades mean that miners have to shift more earth, more rock, in order to extract the same amount of gold. That requires more energy and it's more costly. The underlying cost for producing gold is rising, and I think that's going to support prices in the longer term anyway, around this sort of $1,400, $1,500 per ounce mark.
Thank you very much, Nick. Well, tomorrow we'll be looking at emerging market currencies for our targets and focus, but for now, goodbye.